26 minutes to go before the top of the hour. We're having a conversation of tax matters. We're joined by, of course, our financial advisor, Ashley Polish. She joins us in the studio. Sidney Fletcher is a senior tax consultant at Tax Consulting SA. And we've also got Mark Hawes, who's a certified financial consultant at Alexandra Forbes. Thank you so much to all of you for joining us in the conversation. Sidney, welcome to Power Lunch.
Thank you very much. Good afternoon, listeners.
And Mark, welcome to Power Lunch.
It's great. Well, thanks for having me.
And Ashley, always a pleasure. You always frustrate us every single Monday, but we know that it's for our good because we need to make money. So thank you for thank you for joining us. Maybe let's kick it off, guys. And this is it, Power Family. We're having a conversation on your tax matters. Are you having a tax issue? There is no question here on this platform that it will be a dumb question because this thing trips me up too. So if it trips me up, I'm sure it trips a lot of us up as well. So Sidney, take us from the start. What kind of tax do we have in this country that we are supposed to pay? Should we be working?
Okay. In South Africa, we actually have a lot of different taxes and levies. This ranges from estate duties, capital gains tax, donations tax, customs and excise, and all of those different taxes. Our taxes are split into direct taxes and indirect taxes. Mm-hmm. So your most famous indirect tax will be your VAT that are levied on all the transactions that you as a consumer make. But the indirect taxes is your income tax, your corporate income tax, and that includes your pay-as-you-earn. And that is the pay-as-you-earn that every normal South African citizen pay. Those are the taxes that are deducted from your salary on a monthly basis or that are calculated annually, which citizens get or persons get assessments for.
So your direct tax will be then your income taxes you're paying.
Yeah, your income taxes. That are the taxes that are levied on persons.
Okay, and then the business pays VAT, which will then be your indirect tax.
Yeah, your businesses on your daily transactions will be calculating VAT, the indirect transactions, the indirect VAT levied on the transaction. But at the end of the financial year or every 6 months, they also have a portion of income tax liability to calculate.
Okay, income tax liability. That is when?
Yeah, that is when they calculate what their profit was for a 6-monthly period or a 12-monthly period, and they pay the subsequent taxes should there be a profit that is taxable.
Okay, now great. Now take us through the beginning. Income tax, which is going to be a significant focus on today's show as well. Yeah. Income tax. How much should somebody be paying income tax?
Okay, the income tax for individuals vary. So the more you earn, the different tax brackets you are put in. But in our tax system, we've got rebates built into our income tax system. Now, for your normal individuals, what your rebate does is your rebate ensures that a certain amount of your income that you earn is tax-free. So if you take, for instance, a person that is under the age of 65 years old that earns a salary of 87,000 Rand, 87,500 Rand, the tax on that amount would be 15,500 Rand. But your rebate is equal to that amount. So your
when we're saying rebate, what are we meaning? Are we saying that's the money I'm getting back? I've paid attention when you say money that I get back. So what's your rebate?
No, there's a difference between your rebate and your refund. Okay. So there's a bit of a deep difference there. A rebate is built into your calculation to calculate the tax that is payable at the end. So that is a rebate that every person in South Africa gets.
So that is inside of you. That is already calculated within the salary, and you don't get it back, right?
No, you don't get rebates back.
Okay, so when we're looking at actually just to expound on that with the different types of taxes, I think the thing that kind of irks many people is, why am I paying so much on my tax? You know, why do I pay this exorbitant amount? And what is it dependent on? You're saying that the higher, the more you earn, the more tax you're going to pay. But in some cases, the tax gets so much that it feels as though you are living off just a small amount when when government takes off this huge chunk of amount. And people often cases at the end of the month, I won't lie to you, they feel robbed in some way.
100%. So when we look at that, I mean, as Sidney's mentioned, there's so many various taxes. When we speak about personal income tax, the golden rule is you pay tax on everything. The more you accumulate, the more you're going to pay taxes in some sort of way. It's either going to be capital gains tax, interest tax, dividends, whatever it is. But we also need to understand the tax situation within our country. And we are quite a highly taxed country overall around the globe. And once you navigate, and I think Mark will touch on that, is once you navigate and you start learning more about tax and you know how to use it in your advantage, that's when you can get some more money back and generate wealth from that. And that's where it becomes important on really focusing on your personal financial planning and your finance matters on a month to month.
So hold on. Tax can make me wealthy.
There's a couple of ways you can work around that, yes.
Mark, tax can make me wealthy. I heard tax, which is almost the opposite of wealth. So I heard tax and I heard wealth. So you're saying tax can actually make me wealthy. How?
The simplest solution is pay less tax. I would dare even to say that it's an obvious solution. The trick is how. The question that you asked. What you're ultimately trying to do is improve your cash flow. Like you say, people are getting to the end of the month and there's just not enough money in the bank. So what you want to try and do is improve your cash flow. That's ultimately what you're trying to achieve. Two major ways to do that is pay less interest on debt, but more to today's topic is pay less tax. The first and easiest way to do that is to put money into a retirement fund, any retirement fund. The tax deduction is the same because the tax deduction doesn't apply to the fund, it applies to you, your income. So it's aggregated across all contributions to retirement funds. That money that goes into a retirement fund earns tax-free growth. It was mentioned earlier, income tax and capital gains tax. Pretty much you have to pay on everything except money in a retirement fund. That's not a mistake. That's not a loophole. That's a specific and dedicated tax incentive to save for retirement. And if you do that, you get tax-free growth, which means ultimately you get more money, but more to present day, within 1 year, the next tax season, depending on how you're contributing to retirement funds, you can get a tax refund, which is what you were talking about earlier, as opposed to a rebate.
Yeah, and more than anything else, and I hear you with the retirement fund, and actually we've spoken a lot about retirement, right, and how we need to be able to save for retirement. My only qualm with this retirement fund is that if I even put money in there, am I able to get access to it when I'm 40 instead of when I'm in my 60s and I'm thinking about retirement? Is that open for me like an investment policy where I can dip in from time to time when I need to cover certain expenses?
In certain circumstances, yes, depends on how it happens and what happens. But the general consensus is one shouldn't be looking at your retirement fund to fund any sort of lifestyle pre-retirement. And that brings back to the question of looking at your full financial analysis on what you're looking at. You need to have things like your emergency fund and so forth, which then cater for those kind of things. A lot of people think that the Pension Funds Act is against them. But not necessarily. When we look at what happens in South Africa and what's happening on the ground with everyday citizens, is that the vast majority of people that cannot retire. So if we then have the opportunity of digging into our retirement funds, best you bet we're going to. And we're going to even dig that ditch even deeper. So in that sense, I would rather rephrase it and saying let's rather focus on the psychology of not wanting to dig into our retirement funds and rather make other provisions for that.
Okay, but then I need to know, how do I get the refund? Sidney, how do I get the refund on tax? Because in some instances, depending on the type of contract that you've got and that you've signed, as you were mentioning, it will determine what you pay for tax, right? So under normal circumstances, when you know that so much is coming out of you, how do you get something back?
If at the end of the financial year, or at the end of the tax year, or during SARS tax season, you will actually declare your income to SARS. So SARS will do, what they do is they calculate your income right from the beginning. Remember, your tax will calculate it on a monthly basis to determine the pay as you earn that you must pay on a monthly basis. But at the end of the year, SARS actually, let's call it a final calculation. SARS does to determine what the total amount of tax that you should have paid. Then your contributions to retirement funds come in. Then your rebates come in. Then your tax credits, your medical aid tax credits, those type of credits come into being. Then your recalculated amount, tax amount, is then reduced by whatever allowable deductions there was. Then SARS will balance it against the tax that you've already paid on a monthly basis against this, let's call it new calculation or final calculation, and the difference between those amounts you either have to pay in or will get refunded to you.
And when we're talking about refund, Mark, a lot of times it's also the issues of, for example, your medical aid tax credits. But how many people know that you can actually claim back from the receiver, on your medical aid, that you need to keep certain, items available? So in that light, I understand the retirement fund. I'm not in retirement as yet. That money will be resting somewhere. But to make money now, wealth now, Mark, medical aid tax certificates and the like, what must we be doing?
Look, first of all, keep all your tax, your medical expenses. Ideally, what you want to do is every time you spend on medical expenses, try claim it through the medical aid, even if your savings have run out. Because what will happen is your medical aid will issue a tax certificate at the end of the year with all the expenses that they did not pay. And that you can then obviously submit to the receiver of revenue when you do your tax.
Wait, let me understand
submission.
this clearly, Mark. Even if the funds run out of the medical aid, I can still go to a pharmacist and make a purchase from my medical aid. And if they say, sorry, ma'am, you've exhausted all your income, then what do I say?
So you still wanted to go through and you literally, it sounds a little bit counterintuitive, but you want the medical aid to formally decline payment and keep record of that. So that when you then claim for tax deductions on medical expenses, you can prove that the medical aid didn't pay it and you did.
And then you get money back from that.
Yeah, well, it depends on your income because there are limits, but there are medical deductions, medical expense deductions that you can claim.
See, this is why I've got you guys here with me. You see, these kinds of tricks. We never know these kinds of tricks. Let's go straight to the phone lines. We're helping you with your tax matters this afternoon. Ngwato in Midrand. Hi, Ngwato.
Yes, ma'am. How are you?
Very well, thanks to you, sir. Go ahead.
A small business that gives me an extra income, but now it's not VAT registered or it's not registered with SARS. So now I need to understand as to how much should I be making either per year or per month for me to qualify to register for tax.
Okay.
Yes, that's the only question that I'm having.
Sidney?
Seeing that the income that you get, they are not subject to pay as you earn on a monthly basis. Therefore, SARS requires you to declare that income that you get after you've done your income and expenditure statement on your business, to declare the profit that you make there with all your other income. So if your salaried income was 100,000 for the year and the profit from your business is 50,000, the amounts will be added together to determine, to recalculate your final liability for that particular year. But like I said, there is an income and expenditure statement that you must draw up where you will claim all the business income, business expenses against the business income, and then the balance will be added together.
Okay, but then help me out here. Then how much must it be at a minimum in order for me to register for VAT? Because Ngwato has not registered for VAT. What must that amount be?
Okay, remember, you to register for VAT is not compulsory in SA. So you must only register for VAT if your business has a turnover of 1 million rand a year. So let's forget about the VAT now. So now let's talk about the income tax. There's no for your business to be registered. There's no limit for income tax purposes. It all depends on what type of business you are operating. If it's a sole proprietor, if it's a one-man business, the income gets added to the one man's other income. You understand? And for income tax purposes, you can trade in different entities. You can trade as a sole proprietor. Some people trade in trust, have business income in trust, and other people have in companies.
So which one gives me the less tax to pay?
It all depends. We're going into a much bigger field when we go into the different ones. If you trade in as a sole proprietor, you will be subject to the growing scale, where the minimum is 18% and the maximum rate there. For companies, the tax rate is fixed. For trust, the tax rate is fixed also. So if you earn 100,000 Rand as a company, it will be fixed at 28%. If you earned 100 Rand as an individual, it will be the growing scales that will be applied to that 100 Rand.
So it's not all crystal clears.
It is. When you move into that field, into the different business entities that you trade in, it becomes difficult in that circumstances. But in this case, if it's just a one-man business, if it's just the amount will be added to your personal income tax, your personal income, and then other rebates and thresholds and all of that will come into play also. Then it's not a flat rate anymore.
Okay. I hear you, Sidney. I need you to stop thinking about how we're going to save us money, okay? So that is the premise of this. How are you going to make us richer by the end of this conversation? Mark, then how much should one be earning roughly in order to generate this wealth, so that we can stop benefiting from the refunds and we can stop benefiting from I don't know if you can benefit from rebates, but, I'm still wrapping my head around the rebates. But what's the amount that I'm supposed to be earning?
Look, I mean, it would be lovely to put a single number to it, and that really means you need to be paying tax in the first place. So, look at your tax tables and where you start paying tax, 18%. That's where you would start paying tax, which is when you could start getting tax back and tax benefits. The important part about starting to create wealth, particularly using tax, is in the very sentence itself. You need to start creating wealth. You need to start putting money aside, investing money. What a lot of people are not aware of, because it doesn't really affect too many people, so when you start making decent money that it does, is interest that you get in the bank is in fact taxable. Rental income is in fact taxable. Interest, there's certain thresholds where you don't pay tax, but starting to build up these different structures using tax-free savings accounts, like I've already mentioned, retirement annuities, these create investment structures where your wealth can start building on itself, enjoy that compounding effect without increasing your tax. I know a lot of people want to dip into retirement funds and all sorts of structures to now start renting houses, building houses, starting businesses, these types of things, and they're under the impression that those structures are not taxable. Unfortunately, they are, but done correctly, not only do you pay less tax, but ideally that tax can go into structures where you earn tax-free growth.
I hear you. Ashley, a lot of times, well, now, not a lot of times, but now, we're in a COVID-19 pandemic and people are starting to work from home. And because people are starting to work from home, it's almost like conducting a business at home.
Yeah.
And they always say that in that way, I can present that to the taxman and say, but hold on, guys, I'm working from home. I'm using X amount of square meters for my business. And therefore, I get to claim. Under what circumstances does that happen? Would you just explain to us there? Because the majority of people are working from home and they want to know, can they use their office in the house or their little TV room and say, actually, within this 100 square meters or whatever it is, this is where my business is conducted by fire, by force, so therefore I'm supposed to claim.
Correct. So Sidney will be able to add on to this. But for example, in my case, I'm seen as a consultant, right? So I've got a home office as well. So let's say 100 squares of my total floor usage, I use 10 squares to conduct my business. That's where my office is. So whatever portion I'm paying to the bond or rent or water and lights, I then claim that percentage of that back, and sit down with my tax consultant. But with regards to normal employees, I know SARS released a letter recently or a statement with regards to claiming and working from home. And I'm sure Sidney will be able to fill us in. I'm not too sure on the nitty-gritties of that exactly.
And Sidney, please fill us in. Times have changed. People want to work from home, but can they claim?
Technically, under the law, yes, they can claim. The employer should just issue something stating that is a condition of their employment. They should create a policy around working from home and all of those type of things. before you will be allowed to claim that amount. But from SARS' point of view, that there's certain criteria that area must also adhere to. Number one, it must be used as a bona fide business area. There can't be a lounge in there. The children's PlayStation games can't be in there.
Yeah.
So it must only be used for business purposes. And then more than 50% of your business should take place in that particular area.
Got you. What are tax directives, guys?
Okay, so tax directives, let's say you earn a fluctuating income, right? Let's say you earn commission. All you're basically doing, a tax directive levies or levels out your tax that you pay. So, for example, if you're earning 100,000 this month and 20,000 next month, you're continually fluctuating between the tax tables, right? So one month you're paying more, the next month you're paying less. So a tax directive levels you out where you can say, okay, I want to be taxed at a 25% or a 30% over that same period. And then the recon or the calculation gets done then at the end of the SARS year. And then if you either owe or you get back.
Oh, so you can level everything out. Kathy in Pretoria, very quickly as we wrap off. Hi, Kathy.
Hi, good afternoon. It's
Hi, babe.
my question is based on copayment. Is one able to claim the copayment? Because when I'm asking, 2 weeks back, I went to do an eye operation, and then I was required to pay an amount of about 2,005. So I just want to find out from the panel if one can claim for that.
From a co-payment. Mark, can we claim?
Sorry, I didn't quite hear that.
How do you claim from a co-payment? So can you claim tax? Maybe Sydney, you can also help us.
So that we must remember, and this is a common misconception, is that the money that you pay, the amounts that you get back is taxes that you pay. So that co-payment will definitely be used in the calculation of your total medical expenses. So it will add your medical deduction, and maybe if depending on your income, it will reduce your taxable income. So what I'm saying is that always add that to your calculation, because it might reduce your taxable income and you get a portion of that money, a portion that you taxes that you've paid, you will get back once SARS has recalculated it.